It's Tuesday, January 24th. I'm Curtis Hollister, and you're watching 52-Week Low, the show that provides insights and opinions on the companies at or around their 52-week trading low. Today, we're talking about two picks from the energy sector. The first is NRG Energy, trading under the symbol NRG, and the second is Bill Barrett Corp, trading on the New York Stock Exchange under the symbol BBG. Joining me today is Dana Blankenhorn, a top contributor on Seeking Alpha within the technology and energy sectors. Dana, welcome to 52-Week Low.
Good to be here.
Dana, before we get started, Giants or Patriots?
Patriots.
Perfect. So we're going to be talking about NRG Energy. This is a company, and then we'll talk a little bit about Bill Barrett Corp, focusing on NRG Energy. These guys are a little bit of a different model. They're a wholesaler. They seem to be doing every kind of all things Scottish and pizza of the energy sector. You know, they've got solar, they've got renewables, they've got traditionals. You know, what's your initial take on this company and why it's trading at its 52-week low?
Well, they have the highest earnings per share growth rate among independent power producers, and that's their problem. They're an independent power producer. Everybody in that area of the business is hurting right now because power prices are relatively low. NRG is different from the other guys in that much of its the power that it produces is from solar and wind and some biomass, and as opposed to natural gas or coal or something like this. You may know them, if you know them. The Houston Texans Stadium has one of their brand names on it. The Lion is one of their brand names. The other brand name that you may have heard of is Green Mountain Energy, which puts you in mind of Vermont, but this is actually a Texas company.
So what it seems to me that they're doing, you're looking at kind of their chart here. Right now they're trading at around 1650. You know, they've traded as much as $25.50 in the last 52 weeks approximately. Looks like they do a transaction to buy another solar company. They get a lift, and then within the next month they get another fall. Then they do another transaction to buy another solar company. Then they do another fall. You know, what's causing the downward pressure on this stock right after these transactions? Is this just normal trading activity?
No, the main reason for the falls is simply the prices. Prices for independently produced power are pretty low right now. The reason for that is that the price of natural gas is so incredibly low that those folks, those who are using natural gas, actually have a major advantage in the market. NRG is not using natural gas. NRG is basically a developer. They develop properties, wind farms, solar farms. They often sell these on. And lately, they've been selling a lot of them on to a company called Mid-American Energy. You may never have heard of them, but you can trade on them under the symbol BRK.A. In other words, they're part of Berkshire Hathaway.
Mm-hmm. Gotcha. So obviously, there's a lot of guys kind of behind the curtain, underneath the scenes, buying up these renewable fuels, renewable energy producers. You know, becoming a bigger player without everyone kind of knowing it. You know, the idea here is there going to be a major move on government policy, do you think, or does that even matter?
I don't think policy necessarily matters because what Mid-American has done, what Green Mountain did, and what Mid-American is doing, is creating a private subsidy that they call renewable energy certificates. The Super Bowl this year, for instance, is going to be green. It's going to be carbon neutral. Why is it going to be carbon neutral, you ask? Well, it's because the NFL is buying green energy certificates from Green Mountain that are used to sort of, in an accounting way, take some of the energy that they're producing from a wind farm that they own, mm-hmm. and that, you know, okay, you bought this particular energy, you paid a premium price, you have the certificate showing you paid the premium price, therefore you can call it green.
And lots of companies now, lots of brands, Starbucks, Kohl's, are all kind of wanting to link their brand to buying energy that's renewable, buying energy that's environmentally friendly, buying energy that's kind of important for their customers.
Well, you just named Green Mountain's customers. Kohl's and Starbucks, all these companies that are going around saying oh, we have green energy. We are carbon neutral. That's the business model. They buy these certificates and then they say they're carbon neutral because they're accounting for the solar or wind power that these projects are generating. And they're paying in the price of that certificate the difference in cost between, say, getting it from the grid normally and getting it through these other means.
And so the other thing that they're dabbling in now is the ethanol or cellulosic ethanol. This has been a big promise for a long time, but nobody's really kind of got a major production facility that's really kind of making money or has a line of sight to actually being a profitable business at the end of the day. What's the story behind this?
Well, it's not really material to NRG's results, but they do have a business that they've invested in called Cool Planet Biofuels. They've just demonstrated what they call negative carbon gasoline. The waste from the production process can actually sequester carbon. Now, they've got other investors besides NRG. Google Ventures, ConocoPhillips, BP, GE. All of these companies are really nice to have in the Rolodex when you want to do another deal.
Gotcha.
And that's very important to NRG.
So
having other business partners to buy the projects that it's developing and resell the power that it's creating is key to their success.
So it looks like this is kind of a good buying opportunity for this company from the point of view if you want to align with one of the companies that once energy prices start going up, these guys are going to benefit not only from that wave, but from the bigger kind of white space trend of people wanting to buy renewable energy.
Exactly. They are not subsidized by the government. They're subsidized by the market.
Mm-hmm. Well, I mean, it's one of those things. I think we've talked a little bit about this in other conversations. People are choosing to do this. They're willing to pay a little bit more for the, fair trade coffee. They're looking to pay a little bit more for, renewable XYZ for the, the recycled Crocs, whatever it is. People are making that choice en masse more and more, especially within the North American market.
And it's true for both individuals who they put a solar panel on their roof and big corporations.
Absolutely. Let's change our focus now to Bill Barrett Corp. These guys have a little bit of a different model. They're focused on oil and gas, primarily within. I think all their operations are within the States, are they not?
Yeah, they are primarily playing in the Rocky Mountain oil patch. This one really takes me back in time because I actually started my career in the Business Journal in the late 1970s, covering folks like this, covering guys who were going around into the oil patch looking to do deals.
Well, they're announcing, and they seem to be kind of like continuing to reinforce their production forecast. They're looking at a 20 to 25% production increases. Yet their stock is trading around its $30 or it's $28.44 right now. But it's trading as high as
hit a new low today. They actually hit a new low today, and the reason is exactly what you say. They're producing. What are they producing? They're producing natural gas. Mm-hmm. What's the price of natural gas? It's about half what it was 2 years ago. This provides a great tailwind to the general economy. But for somebody who's producing natural gas, it's a bad thing.
Gotcha. And what's their mix of oil to natural gas, or from a revenue breakdown? Do you have?
From a revenue breakthrough, it's just about all gas. It's just about all gas.
Okay.
They're going into fields that had been previously played, and they are using hydraulic fracturing, otherwise known as fracking, to crack the rocks deep under the earth and capture the gas that comes out as a result.
Gotcha. So again, this is another company. When natural gas starts to turn around, all of a sudden they're going to start to turn around. What about their cost of production? Do these guys have any kind of market advantage over the other players within the space?
That is going to be a big bone of contention once prices do start to go around. And the thing about oil and gas production is you have a lot of sunk costs right up front. But then once you get the production going, the incremental cost for each additional MCF that you produce, for each barrel of oil you produce, is very minimal. So the question is, can you get the capital to pay those sunk costs to get the access to that resource? And once you pay off that capital, once you pay off mostly a loan, then the incremental additional costs of pulling it out are practically zero. But there is such a glut now that yesterday, one of the largest frackers, Chesapeake Energy, which despite the name is also based in Oklahoma, they announced that they were going to cut back on their spending, cut back on their development and drilling, and try and produce only as much gas this year as they produced last year. The purpose of that is very simply to raise the price, and it did temporarily. The question now is that higher price sustainable? Will the other players kind of play OPEC with Chesapeake and say, okay, I'm not going to increase my production either? And if they can do that, then they can make the price increase hold. But a lot of analysts question whether they can.
Well, a lot of the analysts have a pretty strong rating on this company. You've got, like, out of the 11 or 12 analysts that are covering this, 10 of them have it as a buy.
Yeah, they all like it. They all anticipate that they're going to continue to find gas. Now, you should understand there is a slight political risk in that the Rhone Valley, which is one of the areas that they're trying to frack, there's a lot of environmentalist pressure against their acting. I've seen a lot of in liberal media indicating that these guys are really evil. They're about as evil as anybody else in the oil patch, but because they are in a relatively pristine area, and there is a risk in fracking of things coming to the surface. And
also the hydrogeological elements of influencing the water table.
Exactly. Yeah. Right. There was a blow up of a Chesapeake well last year in what's called the Marcellus Shale, which is actually like eastern Pennsylvania. And that was a major event. It happened, I believe, March or April of last year. And that put things back for a lot of folks, and of course raised the political risk, raised the costs for everybody, and that reduces the profit margin.
Yeah, the average target that I think most analysts have is around $48 a share right now. So these guys are a lot, big time underwater from that point. Obviously this is.
If you believe the analysts, this is a place to put some money because they are at about half of where the analysts say they should be.
Yeah.
Now, what you've got to be really careful. If the analysts suddenly turn on this stock and say, "Well, it's not really a $48 stock. Maybe it's only a $30 stock," you're sitting on your position. You better be ready to blow it out if the analysts change their mind.
Yeah, and obviously just a couple of right moves within the market price for gas is going to move the stock probably pretty
but the
aggressively.
The real story here is the natural gas glut. There is a huge glut of natural gas in the North American market. In fact, the Energy Department just this last week put out a new estimate for the energy supplies and demand in this country, and they indicated that this country, the United States, will be basically even on production and supply, on production and drawdowns on natural gas, self-sufficient in 2016, just 4 years away. And if we continue to have these kinds of prices, it's a huge tailwind for everybody in the economy.
Yeah, exactly. All right, Dana, thank you so much for your time. If you'd like more information on Dana Blankenhorn, you can visit his profile on Seeking Alpha. If you'd like more videos from public companies or industry experts, please visit investorchannel.tv. You're watching 52 Week Low, and I'm Curtis Hollister. Thanks for your time.